Look, if you bought into the tech rally over the past month, I get it. Last week was such a roller coaster ride. But this week's inflation data is about to decide which way you fall. Okay, if you're short on time or you just stumbled onto this channel and think, who is this random guy with a cat in his username? Here's what you absolutely need to know. QQQ formed a hammer candle last Friday. That's typically bullish, right? Well, yeah, but your momentum indicators are screaming the opposite direction. So either this hammer confirms and we rally, or it fails and things get ugly fast. This week's CPI reveal would be the catalyst that decides which one happens. Stay with me, and I'll show you exactly what to watch for and which price levels matter. Alright, so for those of you who are new here, welcome. I'm DataCat. And no, that's not some clever branding exercise. I genuinely just like cats and data, and apparently I lack the creativity to come up with anything better. And a little about me. I spent the better part of my 20s as an analyst buried inside a Fortune 50 company. You know the type. Messy data down the pipeline, garbage in, garbage out, unnecessary stand-up meetings, performance reviews that somehow always ended with meets expectations no matter how hard you worked. I traded that corporate nonsense for, well, this. Lasers, mechanical keyboards, and talking to a camera in my apartment like a semi-functional adult. This channel's only about 3 or 4 months old, so we're all figuring this out together. By the way, totally got it about the complaints of my audio quality. I'm planning to get a new mic this Christmas. Please bear with me for the moment. Hey, the bright side is, at least you'd know I'm not some AI repeating gibberish here. And I'm not here to brag or sell you some course, or tell you I made 6 figures in 6 months trading from my couch. I'm just a guy who spent years reading the same research reports the big institutions get, building similar models they use, and frankly, getting tired of watching retail investors getting played blindly. And yeah, I'm an introvert, so if I seem a little awkward on camera, well, you're not wrong. But the data doesn't care about charisma, and neither should you. And if you are in for this kind of approach, like and subscribe really matters to a small channel like mine. Anyway, enough about me. You're here because you want to know what's happening in the markets this week. And honestly, it's setting up to be one of those weeks where you either position correctly or you spend the weekend wondering what just happened to your account. So, let's set the stage. Last week was, let's call it educational. Tech stocks pulled back even after several AI leaders posted strong earnings. You know what that is? That's classic sell the news behavior when valuations are stretched tighter than a cat's patience during bath time. And trust me, I've tried giving my cat a bath. His moans managed to convince me that I'm actually killing him. But here's where things get interesting. And I say that carefully because I know some of you are allergic to overused phrases, so let me just say, the setup for this week is legitimately different. First, the government shutdown. You probably just read the headlines. The Senate finally advanced a bipartisan package to reopen things after 40 days of, let's call it political theater. It's a stopgap running through late January, plus 3 full-year appropriations bills. It still needs to pass the House and get the president's signature. But the fact that the Senate moved forward is constructive. Markets hate uncertainty more than they hate bad news. And this removes one layer of that uncertainty. Now, does this fix everything? No. Could the House still mess it up? Sure. But the overnight futures lean risk on going to Monday's Asia session. And that tells you something. Institutions are treating this as a relief bid, at least for now. Second, and this is where it gets a little wild, there's this whole tariff dividend thing floating around. President Trump mentioned checks of at least $2,000 per person, funded by tariff revenues. Treasury Secretary Bessent walked it back a bit, suggesting it might come as tax relief instead of actual checks, and obviously any of this would require legislation. So, don't go planning your vacation around it. But here's the thing, markets simply don't price certainty, they price probability. Even if this ends up being tax relief instead of checks, even if it gets watered down or delayed, the narrative is out there now. And that narrative, more money in consumers' pockets, funded by tariffs, adds an upside optionality to consumption and sentiment. It's hopeful, maybe a little speculative, but it's the kind of thing that can support risk assets in the near term. So you've got 2 macro tailwinds heading into this week. Shutdown progress and stimulus chatter. Not bad, right? Well, okay, so here's where I'm gonna be that guy. The one who shows up to the party and reminds everyone that the punch bowl is spiked and the host didn't pay the electric bill. Because while those macro tailwinds sound great, they're completely secondary to what's happening Thursday and Friday. CPI drops Thursday, PPI drops on Friday. And if you think the market cares more about shutdown progress than inflation data, well, I've got a bridge to sell you. Or maybe a cat who actually enjoys water. Anyways. Now, here's the wrinkle. Tuesday is Veterans Day. The stock market is open, but the bond market is closed. So you're going to have thinner liquidity in rates on Tuesday, which means any whisper numbers or early leaks on Wednesday is going to spook the market, driving up volatility going into CPI release on Thursday. Just like how your cat decides to sprint across your apartment at 3 a.m. for no reason. The impact is way bigger than it should be, because everything else is quiet. If CPI comes in benign, if we see core disinflation progress, long-duration growth assets, that's your mega-cap tech, your AI names, should catch a tailwind. Lower yields, easier financial conditions, all that good stuff. But if CPI surprise is hot, oh, buddy, you're looking at higher yields, a continued rotation out of expensive growth, and renewed focus on valuation dispersion within tech. And given how stretched multiples are right now, especially in semis and high multiple software, that could get ugly fast again. Alright, so let's talk about what the chart is actually telling us, because this is where things get, let's say, nuanced. And by nuanced, I mean terrifying if you're long and hopeful if you're looking for an entry. QQQ closed Friday at $609.74. That's down about 0.3% on the day, which doesn't sound like much. But zoom out a bit. We're now trading between the two Fibonacci retracement levels at $607 and $613. That's a critical retracement zone. It's where buyers and sellers are duking it out to decide what happens next. Now here's the bullish case, and it starts with that hammer candle I mentioned earlier. Last Friday, QQQ opened down about 0.5%, failed to hold, then recovered into the close. Classic indecision candle, right? But check out the lower wick. It's over 6 times the size of the body. That's a long tail, and it shows strong buying pressure at the $598 low. Buyers stepped in and rejected deeper selling. That's typically a bullish reversal signal, especially after a pullback. Plus, the golden cross is still active, 97 days strong. The 50-day moving average is at $601, rising at a healthy slope. QQQ is still about 1.4% above it, so there's a cushion. On-balance volume is still positive over the past 20 days, accumulating at about 14.9 million per day. So the bulls have some ammunition here. But, and this is a big but, and I cannot lie, the bearish case is equally compelling. Actually, scratch that. It's more compelling technically right now. RSI collapsed from 71.7 on October 29th to 47.9 last Friday. That's a break below 50, which is a momentum shift. The MFI dropped from 75.9 to 58.4. That's money flowing out, even as price is holding relatively steady, not great. QQQ is now trading about 1% below the 20-day EMA, which is around $615. That's the first meaningful break of the trend in weeks. The MACD histogram is falling and it's been dropping for 3 bars. That's a bearish crossover in progress. The stochastic K-line crossed below the D-line, another sell signal. Oh, and volume. Volume spiked about 1/3 of the average on that down day. That's distribution pressure. That's institutions selling into the weakness instead of retail panic. So you've got a hammer candle that says buyers showed up, but you've got momentum indicators that say, yeah, but sellers are winning. Okay, so here's how I'm thinking about this, and you can take it or leave it because I'm not your financial advisor and this isn't advice. But if I were looking at this setup, here's what I'd be watching. First, QQQ needs to confirm that hammer with a close back above $615, ideally on volume above recent average, which is about 60 million. If it does that, the hammer is validated, and you're probably looking at a move back towards 625 to 630, especially if CPI cooperates. But if QQQ breaks below $604, which again was the pivot on Friday, on high volume, the correction deepens. Next stop is 600, or the 50-day SMA at 601. If that breaks, you're looking at 598, maybe even 590 or 588 where there's prior support. So the risk reward is pretty clear. The hammer gives you hope. The momentum indicators give you caution. And CPI is the catalyst that resolves the whole thing. Now zooming out a bit, this pullback in tech aligns with what we've been seeing fundamentally. Valuation concerns, liquidity worries, year-end positioning. Some of the AI infrastructure names are trading at full multiples, and after strong earnings, you're seeing classic sell the news behavior. That's not panic, that's profit taking. The question is whether it's healthy consolidation or the start of something bigger. And honestly, the 2-day losing streak, the RSI-MFI divergence, the break below the 20-day MA, those suggest institutional profit-taking. But the hammer, the positive OBV, the golden cross, those suggest this could just be a shakeout before the next leg higher. So if you're in semis or AI infrastructure, fundamentals are still supported. Data center capex, AI adoption, all of that is real. But multiples are full, and you're going to see heightened sensitivity to rates heading into Wednesday. Quality within AI, free cash flow, pricing power, diversified demand should outperform the more speculative plays. Software and inference names leveraged to AI-enabled productivity can hold up, but high multiple, low profitability software is vulnerable if we get a rates pop. Honestly, in a week that hinges on macro prints like this, mega-cap cash-rich platforms tend to act as a relative safe harbor. Think your Mag 7. They're boring, sure, but boring is good when volatility picks up. Oh, and one more thing before I wrap this up. Last week, the Supreme Court heard arguments on the legality and authority underpinning the broad tariffs. A ruling, timing uncertain, could move rate and inflation expectations and hit tariff-sensitive equities. So that's an overhang. Not immediate, but it's out there. Just something to keep in the back of your mind. Alright, so to tie this all together, this week is a decision point. You've got macro tailwinds from shutdown progress and stimulus chatter. You've got a critical technical setup in QQQ with a hammer candle that needs confirmation, and you've got CPI and PPI landing midweek to resolve the whole thing. If CPI comes in soft, and QQQ confirms that hammer above 615, you're probably looking at a relief rally back towards 625, maybe 630. If CPI comes in hot or QQQ breaks 604, you're looking at a deeper correction towards 600, maybe lower. The market is coiled, it's waiting, and Thursday's data is the catalyst. So, keep your stops tight, watch those levels, and maybe don't go all in on anything until we get some confirmation. Because the last thing you want is to be that cat who jumped onto the stove thinking it was off and burning his whiskers. And now you're explaining to the vet why you thought that was a good idea. Anyway, that's all I've got for you this week. If you found this helpful, hit the like button, subscribe, leave a comment, all that YouTube stuff. I'm still figuring out how to ask for engagement without sounding desperate, so bear with me. Thanks for watching. DataCat out, stay sharp and stay safe out there, and I'll see you in the next.